All right, the market finished out the week on a pretty much a two-sided note. On one hand, the Qs and the S&P 500 finished the week very well, relatively well. A small range, low volume, but at least to the upside, especially for the Nasdaq 100. The Mag 7 companies, Broadcom kind of joining the midst here today. All doing pretty well. Having Nvidia is struggling, relatively speaking, but for the most part, the Mag 7 companies are doing pretty well. On the other hand, the Russell 2000, the Dow Jones Industrial Average, the equal weighted S&P 500, the broadening trade, which was so popular if you watch CNBC over the last few weeks, not so popular this week. So struggling, as you would expect. When the markets are bullish, you typically are going to be led higher. But the problem by the big dogs, right? But the problem is there were some underlying patterns and currents here that would suggest that this week's weakness, at least in the broader area of the markets, could lead to more weakness more broadly and into every area of the market going into next week and beyond. So seasonality will have something to say about that, fortunately. So that might not be the case. But I'm going to break down the patterns, the inflection point on one hand that we're at right now, but the patterns that suggest that we might get to this inflection point and instead of bouncing, might instead continue this week's decline to the downside. So, in fact, we had a pattern this week that we haven't seen since February of 2020. Not to be too alarmist, but I'll show you what that pattern was as well. So we'll break all that down. We'll take a look, despite all that, we'll take a look at a really good bullish breakout pattern in the technology sector, and we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, December 13th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're following us on our blog, check out some of these other things over here on the right, including a Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Scroll down to today's Market Outlook and click on that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicators. You can see the near-term line produced a bearish near-term high point. So we talked about this this week with that low point that did not, that strong bearish low point that did not produce a bull tag like the last few, or even this one that was close to one. Generally, like it did over here, it produces that bearish near-term peak, one that we can't get up to a new high. In this case, it got above 80, but barely there, and it dropped out immediately. This one didn't even get above 80. Right? It was a lower high point. It's peaked at just barely above 60, and it's already in the bearish territory. Now, we came off the lows at the end of the day, so we avoided. It was down at the lows of the day below the 20th percentile, and the momentum line bouncing out from extreme lows was actually sitting at extreme lows for a second straight day at the lows of the day today. So we avoided kind of the worst case scenario from a short-term perspective. Again, we're talking small ranges, even below average range again, even though the range is relatively bigger today, below average again there. So it's not like this was like a doom or gloom day, right? A death knell day. But it could have been a lot worse from a short-term perspective, as you'll see here on some of these other indexes. We are not 2.5% above the moving average anymore, so we're weakening there. Generally, that leads to a cross below zero. When you start to weaken below that 2.5%, it leads to a cross below zero, right? In this case, we didn't get the red bull tag. It almost got to zero. You can see the weakening there from 2.5%. We drop down. Here's some weakening. We pop back up. But you can see when you get the weakening, it tends to work its way down. And we've been working our way. It's not quite below that 1% mark yet, but it's getting a lot closer. It's definitely weakening. And we've seen this in a lot of these other instances. When you get these bearish near-term peaks, that tends to occur during these weakening times and right before it crosses below zero. In other words, the index crosses below the moving average. Market sentiment's dropping. The intermediate line still in the upper reversal zone. It's crossed below the 90th percentile, so it's not extremely bullish anymore. but at least it's still in the upper reversal zone. It's still above the market sentiment line, which is also still there. They're both falling, but they're still bullish. So we're not any threat of decline per se here yet. And of course, that's being led higher by the NASDAQ 100. It also is potentially forming a bearish near-term peak. It did not drop below the 60th percentile, so it's still actually in bullish territory. So remember, it's that first day it crosses below 60 determines whether or not how likely we are to get. First of all, that it tells us that the near-term peak is done, so then we can determine whether it was bullish or bearish. Right now, it would be bearish if we cross below it on Monday. And then, of course, after the cross below 60, now we start looking for the bearish decline, or bullish or bearish decline, depending upon what that first day looks like. So we've talked about that a lot. The intermediate line is still above the 90th percentile here. We actually rallied today almost 0.75%. We rallied. The near-term line, or market sentiment line, is above the 80th percentile, though it's falling barely. But at least it's above the 80th, and we are well above. I mean, we're almost 4%, as you can see. That's a pretty decent. It's the 84th percentile. If you look at like SPX, remember it's weakening. It is in the 68th percentile. So still 60, right? Still kind of that from 60 to 100. You're still bullish. From 60 to 100, you're still bullish. From 40 to 0, you're bearish, right? And in between, you're more neutral. So we're still bullish, but you can tell that's a much lower number than what you're seeing on the NASDAQ 100. And you can also see, too, if you look at the Dow Jones Industrial Average, we ended up with our 7th day in a row to the downside. That's the last time we had a 7-day decline in a row for the Dow Jones Industrial Average. It was back here in 2020, right here, from February the 20th to February the 28th. That was 7 days in a row for the Dow Jones Industrial Average. We actually fell 13.5%. We were 11% below. We fell during that 7 day. We fell 13.5%. Today, this 7 day period is like 3.5. It's like hardly. Let's see here. We can see from the close what it is on the zigzag chart. 2.5. So it's like 2.5%. And again, that other one over here was about 13.5%, 14% at the close. So yeah, that's a much different. The tale of two 7-day losing streaks, and one of them is vastly different than the other one. This one that we currently have, but it's still 7 days in a row to the downside, and we did produce a bull tag today, though we are barely below the moving average. We do have another day of extremely bearish short-term sentiment. The intermediate line has crossed below market sentiment. That's bearish. And they're both below 80, right? So the crossover occurred, in this case, below 80. So that makes the, bearish there. So now, again, we've seen bull tags bounce, and this has a very good chance of bouncing because we're not that far below the moving average. But it did produce a bull tag. So now we're kind of on alert because we either bounce or it starts a new near-term decline. It's one or the other, or intermediate decline. So that threat is there. The Russell 2000 produced the bull tag yesterday, Friday. It fell barely below, 0.2% below, but it built on it today is now a full percentage point below. We fell down 0.6%. Bearish short-term sentiment, intermediate line crossing market sentiment. Much different story for the Russell 2000 and the Dow Jones Industrial Average on their respective market forecast charts. So if you look at the weekly chart for this, it's also a little different too. This is a bullish intermediate confirmation signal. The momentum line's oversold, but not extremely oversold. The near-term line's in bearish territory, but it's not in the lower reversal zone. And the intermediate line is in the upper reversal zone. So that combination is pretty darn bullish, right? It can be pretty bullish. So next week, we have a really important week because we're either going to bounce out of this according to this signal, or we're in trouble, right? Because you would consider this, we had a bullish peak here. You would consider this a relatively bearish near-term peak because it barely got above 80 and it was down the very next day. This is week number 1 of it crossing below the 60th percentile. Ideally, you want to be able to produce this intermediate confirmation signal on day number 2. But this is day number 1, and the momentum line is well into the reversal zone, suggesting a likelihood that the near term line follows suit. So while we do have in by definition a bullish intermediate confirmation signal, we would expect a bullish week next week. The fact that that we dropped below 40 and below 60 and below 40 in the same week, and we have relatively pretty bearish, almost extremely low momentum line, suggests that it might not bounce. Right? There's pretty decent odds that it won't bounce, and that's my expectation. I think we're due for continuation of this weakness, as you'll see here in just a second. On the Russell 2000. NASDAQ 100 is a different story, remains strongly bullish. We did not get a cluster. We came very close last week to a cluster in the 76th percentile. We did not get a cluster this week. The momentum line is still in the upper half of the chart, though, and the near-term line is strongly bullish. It's highest level for the near-term line going way back, right, into 2024, into February of this year. So very strong move. Intermediate lines above the 90th percentile. We're almost 10% above the 30-week moving average, which is only the 65th percentile. So we're not even that, strongly bullish. But keep in mind, you don't expect that we will, right? We had our move below, we had our surge through the moving average, which usually ends up being the biggest surge, and then we converge, right? We converge as we go up to higher highs with lower highs because the momentum just gets smaller and smaller. So I don't expect that we will get that much further above the moving average on the NASDAQ, which again kind of suggests the likelihood, that next week might be weaker, more likely to be weaker than it is to not. As you look at the Hakinyashi candle, in this case for the S&P 500, again, a lower high point, right? So you got a lower high point there. Yet last week's close 60.65, this week 60.64. We also got a lower high point. So a lower close, lower close and a lower high point. And we are, again, crossing back below the moving average. We are at a high level, 93rd percentile. We're set up for, this is not a bullish we don't get up a new high or closing high on the Hakinyashi basis, then you're set up for a transition week next week, which means probably a small body, but a upper and a lower shadow, similar to what we saw this week from the Russell. Why? Because 2 weeks ago, we had that same situation, a lower close, a lower high point. It led to a transition candle this week. So small body, a very small body, as you can see here, but it's negative, and you had an upper and a lower shadow. You did not quite cross below. Ideally, if you're reversing, you want to, you typically get a crossover. You didn't get a crossover there on that transition candle. You did on this one. So sometimes you do, sometimes you don't. It came very close. The PPO is also the 98th percentile for the past 3 years and rolling over. So, I mean, that would suggest, and then when you look at the transition candle, when you look at the actual candle, it's pretty bearish. So that would suggest the likelihood that we're going to have a reversal next week too. So something to keep in mind there. If you look at the 3 green arrow chart, your MACDs are all red. You have 3 red arrows, remember, in the Dow and the Russell. That's when you get the bull tag, you typically get, that's the 3rd red arrow usually. Their histograms are pretty bearish. When you look at, again, and when you're trying to look at whether or not the likelihood that this bull tag will bounce, as of right now on the bull tag, it's a pretty bearish low point. The histogram there's a lot of momentum to get to this. If you look at IWM, it's similar, right? If you look at all these others that bounce, including these, the histograms didn't get very low, but here we are getting the 3 red arrows today, and that's a pretty low. I mean, it goes back to this one, it goes back to some of these others that typically start. If you look at SPY, we did not get 3 red arrows in SPY, but you look at some of these that turn into intermediate declines, and you can see their histograms are pretty bearish, and you're pretty low on the stochastics as well. So if you look at, again, IWM, you are well into bearish territory. So on the day you got the bull tag, you got some pretty bearish momentum. You're well in the bearish territory in the stochastics. Pretty decent likelihood. Now, again, not 100%, but a pretty decent likelihood that instead of bouncing, this 3 red arrows is probably going to signify the beginning of a bearish intermediate decline, a period where we get multiple days here of pink shading, right? Not just the one day that we just barely got, but multiple days. So that strings together more, like I said, of an intermediate decline there. If you look at the DMI, right, we'll take a look at some of these other oscillators. Well, let's take a look at the two-line version first. So let's come over here to the two-line version of the chart. S&P looks great. In convergence mode, the MACD is below its moving average. We're still above the 17-day, which is the second number in the MACD. So we're fine there. But IWM is a different story. We are not in convergence mode. We have broken the 17 clearly. We have the 8's broken the 17 because your MACD is about to cross below 0. Your stochastics is in bearish territory, and you're now below the 30. And you've still got some room to go until you reach some support below that 50. So things are much different on IWM, and for that matter on the diamonds as well, also breaking below the 17 clearly, and the MACD and stochastics moving towards bearish levels. Some pretty decent momentum, like I said, a pretty decently strong histogram there, and a lot of wiggle room down to get to that 200-day moving average. We're so far up above that 200-day moving average. Remember, pullbacks get you to the 200-day moving average. Corrections start after you break them. So this can lead to a pretty decent sized pullback if we were to make it all the way. It's doubtful, right? It's doubtful. Not all pullbacks, like this one here, because we were so far above it, not all pullbacks actually get all the way down there. They'll break the 50 and stay below the 50 for a while, but they don't quite get all the way down to the 200. And I would not expect that to be the case here. We're too far. The gap between the 50 and the 200, when it is so high, and you get a pullback when that gap is so big, it's rare that you will work your way all the way down, right? So you can see here. Here we did, but you can see the gap was much smaller. Up here, some of these, the gap was a lot higher, and so you're not going to make your way down there. Over here, you finally made your way down, but the gap, again, was a lot smaller than it was during some of these pullbacks where the gap was so large, and that's kind of how we see it right now. So again, I'm not expecting a huge intermediate decline here, not in the least bit. If you look at the DMI and the ADX, again, you can see, it's relative. It's not bullish. It is bullish, but it's not as strongly bullish as it used to be. We are below 30. We are back above 20. So that's the wrong combination that we want to see. IWM is a little different story. The negative indicator is above 25, not quite above 30 yet. The positive indicator is slightly below 25. So again, this is a bounce opportunity. We either bounce here or, like I said, we start the intermediate decline. So there's still a very good chance we bounce, though, again, for the reasons I just told you, I think the likelihood is lower that we bounce, that we end up starting. Because it does one of two things. We either bounce up to a good new run. In this case, it would be the continuation of the run we've been on since back here, or it would be the start of an intermediate decline, right? Because that's how these start with these signals that you're seeing here. So obviously there's a lot more bounces, as we've already had a few bounces on the current intermediate run. It's the third time a charm. It remains to be seen. We are below 60 on the RSI, but we're still bullish. We're below 100, but we're still in the upper half of the chart. So no issues there on the RSI or the CCI. The Russell 2000, we are below 50, but we're not at bearish levels, so that's okay, right? So, we don't turn it. If this were green like the S&P, it would have turned green back over here when it crossed 50, or actually right here when it crossed 50, and then crossed up above 60 to kind of solidify that. So it would have been green this whole time, never crossing below 40, and still hasn't crossed below 40. The CCI, on the other hand, is well below minus 150. So this is the lowest level it's been. This is not typical. Like when you get these bull tags and they bounce, your CCI typically barely crosses below 100. This is not barely crossing below 100. So again, another sign that would suggest, again, it doesn't, nothing's 100%, but you can see the signs that would suggest an expectation that things may continue south next week. Again, not every single day, right? So when things go on, intermediate declines don't have a down day every day. In fact, intermediate declines actually have bigger up days than the end of the intermediate rallies do. So there will be up days next week. So I don't think we'll have 5 straight days to the downside, but I think we'll have more downside next week than we will have upside when we do have those up days. If you look at, let's see here, the Ichimoku Cloud, the S&P 500 looks great, right? Positive rate of change. We still have intermediate strength trend. We're still right around the green line. Things are great. IWM, not so great. We're below the blue line. We just lost the trend today. Another sign, right, that the bull tag might play out negatively. The fact that we lost, that we had a mature trend and we lost it, right? It's one thing to have an intermediate strength trend and to lose it, and we can bounce off that and be just fine. But once you get to mature strength and then you lose it, it's hard to recover back to an eventually mature strength again without a reset, right? Without a negative. You can see the rate of change has also turned negative because we had that big jump up post-election. Now we have a negative rate of change. So that's also not working in our favor for the Russell 2000. Then finally, the S&P 500. You can see we're still in the upper half of the quartile, though we're not in the upper half of the Bollinger bandwidth, though we're not in the upper quartile. The bandwidth is still relatively low compared to the 150-day range. We are below the upper Keltman channel, so we're and the momentum is declining. That's the SPY. So again, bullish, but not this trending levels anymore, right? We're in convergence mode. IWM is a different story. We are in the lower half of the chart. Now we're not in the lowest quartile, but we are in the lower half now. And you can see the momentum is clearly dropping and is close to flipping from a lot closer now than it has been to flipping from positive to negative. When you look at today's intraday chart, you see we did end up closing above yesterday's low, so good. That was good, right? That was a good end of the day. Better that it's the best that it could have been, right? Given how we were trading below yesterday's low, so that was nice to get a bounce back up. Still, the point of control is very top heavy. It's at the very top of the 4-week range. That's not good, right? It's not necessarily the best sign. That means we're very top heavy. The vacuum is to the downside rather than to the upside. So instead of the vacuum pulling the price up and the point of control is down, the vacuum's pulling, has the potential of pulling it down to the downside. You can see we did close above last week's low. So, again, relatively positive sign. Definitely did not close above last week's high point though. So we did not get a higher high. It was kind of an inside week actually. So not the best sign from that perspective. You can see the Arun indicator is setting itself up for that. We're already hit zero. It's setting itself up for being below 70. And again, the low point by next Friday, Monday, Tuesday, Wednesday, Thursday, Friday, will be right here. So if we don't get new highs by the end of next week, then we're going to have, and assuming no new lows either, then this range is going to really tighten up, even more than what we just saw. Right? IWM's a little different story. The Arun indicator is way off. Right? We haven't had a new high for a long time. We did get a lower high and a lower low again. We've had multiple days of lower highs and lower lows and closing below the prior day's low. We closed way below last week's low point. We are in the lower half of the chart, so that's what this looks like here. We are in the lower half of the chart on this stochastic. So we'll end the bearish territory, no less, below the 40th percentile. Not looking as good for IWM. And like I said, we haven't had a new high for a long time. And again, here's today, Monday, Tuesday. So the new low will stay there. This will get down to zero by next Tuesday. And then Wednesday, and then Thursday, and then by next Friday, we will have a new low. Like we'll have a jump up here. And the question will be whether we'll have a jump earlier than that to 100, or whether we're going to jump up to this, to this low point, by Friday, right? That's going to be a really important thing to watch. I think we get our bearish crossover here and a jump up to 100 by sometime next week. And again, that would be a bearish crossover, and I would not expect it to be a one touch this time. It'd be more of a continuation move there to the upside, because I think the S&P will get close to having a similar pattern by the end of next week. If you take a look at the trading range, I told you the range was pretty small today for the S&P 500. The volume still below average. The range was slightly below average. But still, remember that those averages are extremely low. So we are below extremely low averages. So we're 0.728 here. The volume you can see is down to its 52-week lows again. extreme lows. Again, we saw this before back in 2018 or 2021. At the end of 2021, you can see we also fell to extreme lows on the ranges and the volumes. Right, we had dropped down to new 52-week lows there. We dropped down to new 52-week lows again here, and that led into an intermediate decline that was not the beginning of the correction. We had one more leg higher, but it ultimately did lead to a correction, multiple months later, and that possibility is there for what we may go through again here pretty soon. Let's take a look at the VIX. The VIX ended up down today, down below 14, sitting right on that 80%. Remember, this is an extreme low point. We did not close above 100 on the VVIX. So the VVIX closed down. It was at 96.5. Yesterday it closed at 99.43, so very close to 100. But the fact that the VIX is extremely low, and this time, instead of the VVIX dropping 2, the VVIX actually rallied this week, right? When you look at, here, let's look at the VIX on a weekly chart. So here was last week's VIX, and we dropped down a little bit higher this week, but still hovering at extreme lows relative to the VIX 3M. So that means VIX 3M is still in pretty decent demand relative to the normal VIX. But instead of, like last week, we rose a little bit from barely below 86.32 to last week closed at 87. So at least below 90, which is what we want. This week we jumped up a lot, right? That's a pretty decent sized jump here. Get rid of that. There we go. So this week we jumped up a lot, and that's not what we want to see. Almost got above 100. It came off of 100. We were trading briefly above 100. So something's giving here. Like the VIX is super low, but the VVIX is not. The VIX 3M is not, and of course the skew is not either. The skew remains extremely high, right? We are at, I think that's today's 167. No, today's is 169.91. So this still hasn't been updated yet for today, and will. And you can see the average. That's the highest average it's ever been. Remember, extreme is 150. So we are above 160 on the average now. We're working our way up to 165 on the 20-day average. That is an extreme amount of risk aversion that people are using deep out of the money puts. So deep out of the money puts are in demand. Far out of time, the VIX 3M puts are in demand. So the market's not concerned about a short-term dip, right? We might get a 5% pullback here. The market's not really too concerned about that. But it seems like the market's concerned about a similar type of dip that we saw the last time we had a record run in the skew. Up to that 150 plus level, in this case 155 plus, and at the end of 2021. Then we went into that pullback, and then we had one last leg higher, and then the correction. So that kind of move is what the market is saying, that they're probably more concerned about that kind of move now than they were even then in 2021. All right, now let's talk about what's driving the price action here this week. So let me get to the asset class comparison chart, and let's just go to this week. All right, you can see commodities had a great week, up 2%. The dollar was up 1%, and yields were up 4%. So there's your three-headed monster. In fact, when you look at the yield, the chart of yields, look at that run. 5 days in a row up to the upside. This is what it looks like on the weekly chart. Big move higher. But we also have to remember that yields, there's your move on yields there. Yields will be held in check by where the Fed funds rate is. So the Fed funds rate next week is expected to get to 4.375. That's where the 10-year yield is. So which means that for the first time in a while, in fact, today, your 10-year, 3-month spread finally turned positive for the first time in a long time. Now, for it to get to its normal rate, and once it pulls up here, I'll show you. Once it gets, for it to get up to like say 100 basis points positive, or even 200 basis points positive, right? By at least 100. For it to get up to that 100 basis point or more, that means that the 10-year yield would have to get up to 5.375, assuming the Fed does not cut or raise rates for an extended period of time. That suggests a significant level of inflation if for that to happen. So that's probably not going to happen. So the 10-year yield will be held in check by where that, barring a big jump in inflation, which we'll be able to monitor by what's going on with the commodity index. So if I were looking at commodities, remember they had a good week this week, and you can see they're still below the 200-day moving average. They're above the point of control, but they're still below that 200-day, and we can't really get any escape velocity. There's not a big vacuum up here to pull it up. So we're really stuck around this, center of gravity and are unable to get some escape velocity to really get going, which is a good thing, because if it did, then inflation expectations would rally and you would see the 10-year yield really jump up above. You can see crude oil got above the 50-day. It's done this before, so now we'll see if it actually holds and fills in that gap, and then some. See, last time it filled in the gap, it didn't quite get there. Then it, a few attempts to get above the 50 only to fail. So we'll see if this ultimately fails here next week. And then finally, the third-headed monster of that triumvirate is the dollar index. And the dollar index has been bullish. But again, this will be limited in its upside by what's going on with the 10-year yield as well. So I think both the dollar and the 10-year yield are at peaks. So I don't think that they'll have a whole lot of more upside to them, which will help limit any kind of losses. So again, I think there will be some pullback coming. I think we'll get a new red tag. I don't know if 17.43 will be the final number here. We might go up a little bit more. But the Russell 2000 obviously is close to forming a new red tag at 3.9%. You get a new red tag at 5. All right, so we've had a 5% decline already multiple times since early August. The S&P has not. Your Dow Jones Industrial Average is at 2.63, right? So there's the August low point. So we've gone up 16% since then, and we're over 2.5% decline during this 7-day pullback. So I think the next, like 2021, the next little decline will be 5%. Nothing too major before we have one last leg high. That was an 11%, 11.5% leg higher. Wasn't too bad before the ultimate correction started. So that's kind of how I picture things going here going forward. So especially if we get some weakness in yields, at least it doesn't go up anymore in yields and in commodity. If commodities start to really jump up and yields go up and the dollar stays strong, then we have some issues, right? Then we might end up with a bigger than 5% decline that could lead into something more. But that's a function of inflation expectations, which I do think inflation will be rising into 2025, but I think it will be more limited to around the 3 to 4% range. I think if it were to get above 4% by, say, in the middle of next year, then we'd have some concerns. I don't think that that's going to happen. So I'm not in that bank. So I think the market will be able to have a little volatility here and stay relatively bullish with no rate cuts for 2025. Like, I fully expect next week that the Fed will release their dot plots and potentially keep it at 4 more cuts for this year, but more in the back half of the year. The Fed doesn't do the cut and wait and cut and wait. That's not their MO. So I expect that if we do get 4 cuts, it will be starting in July, and that would happen if we were to get some weakness in the markets and a weakness in our economic growth and earnings growth. Otherwise, I think if inflation continues to move up a little bit, reflecting increased economic growth expectations, then we shouldn't have a cut at all these 4 meetings, and that would actually be a good thing for the S&P, which is why I think, barring a little bit of volatility here, 5% pullback, plus or minus a little bit, that after that we'll get a new green tag in the first half of next year. That will be pretty decent. Whether it's 11.5% like 2021 or not, well, who knows? But it'll be a new green tag to some degree, and then we'll see what ends up happening after that. Let's take a look at the sector moves. You can kind of see, the 12 grid chart I had. Let's look at the sector comparison chart, and again, you can see discretionary and communication services have been the biggest performers over the last 3 months. If I look at the last week, it's those two are the only 2 positive sectors. Staples have done pretty well. Technology has outperformed all these other sectors. They've all been down considerably this week, but barely underperforming the market, just to a small amount. And remember, that's our bellwether. That's the one that we kind of need not to underperform the markets. And if you look at what's going on in those sectors, if you look at the 12 grid, you can see the strength in the top three cyclical sectors up at the top: technology, discretionary, communication services. They all have very bullish market forecast patterns. Everything else, not so bullish, right? So what happened to that broadening trade that was so popular, to talk about over the last little bit? There is no broadening trade. That the broadening trade's a myth. If the markets are going to be bullish, when there's this big a sector disparities, if the markets are going to be bullish, it's going to be bullish because the big dogs are leading the way higher. And that's what they're doing right now. Like, they're the only three up here in the top right quadrant. Everything else is moving down to the left. That's bullish, right? That's what we want to see, and we need to continue to be able to see XLK move up. This is XLY. Now, again, here's another late 2021 analog. XLY had been underperforming 2024 for most of the year. The S&P 500, right? Underperforming. Even though the market's been bullish all year, this sector's been underperforming and then just has gone parabolic. Well, you can see there's other times it's gone parabolic. Like, it went parabolic there from below but got capped by the 200-day. Same thing here, got capped by the 200-day. This one went from below to above it, just like at the end of 2021 to a similar degree. Again, underperformed in 2021 for most of the year where the market was bullish. And then it made this big parabolic move, high CCI, RSI, similar to what we got now, high long-term PPO, even bigger than what we had then, higher ADX and DMI indicators than we had back then, and a higher CCI than we had back then. So everything is actually more parabolic now than we were then. Are we going to get a similar type of pattern going into the end of 2021 where this parabolic peak reverses and then ultimately leads to more softness in the beginning, into next year? So that's a concern, all right? Parabolic peaks can go up longer than we expect they will. So I don't think it's peaking today, but it's definitely a pattern that we've seen before. That's not a pattern that we want to see again, per se. All right, now let's finish up with our trade idea of the day. I want to actually take a look at ARM Holdings. This is a recent stock has recently had relatively recently, but it's been going for most of the year. It started its stock at the end of last year. It's been up and down since it started, but it's above its IPO price, and we've had a down period here recently into some oversold clusters. Now we're on an upswing, and you can see we got a bear tag this week on Wednesday. We built on that bear tag the last 2 days to the point of breaking out today. The intermediate line crossing above market sentiment today, almost in the bullish territory. Pretty decent bullish near-term pattern. A little bit of a long upper shadow, so that's a little concern there. But a bullish pattern, if you take a look at its weekly chart. Here you can see we have a bullish candle after a green arrow, some transitions. It's now turned, the PPO is turning up as well. So those are all good signs. When you look at the 3 green arrow chart for ARM Holdings, you can see we have 3 green arrows there and pretty decent volume the last couple of days. So that's a good sign for the stock. Looking at the regular 3 green arrow chart, the 2-line version, we've been kind of compressed, and now it looks like we're popping, right? That we've been coiling, and now it looks like we're uncoiling as we are at the top of the value area and getting some escape velocity with the bigger moves and the bigger volumes over the last couple of days. When you look at the DMI and some of these other oscillators, you can see some pretty good bullish breakout type patterns. We're above 30 on the negative positive indicator, below 20 in the negative. The ADX, which dropped below 10, is now barely crossed above 10. So that's the infancy stages of any bullish run that we may be getting, something like this. The very infant stages of it. When you look at the RSI and the CCI, you can see we're above 60 on the RSI. We're well above 100, up above 200 on the CCI. So those are breakout type patterns. When you look at the Ichimoku cloud and the trend strength indicators, we now have a weak trend. Right, we're above the cloud. We have a positive rate of change. We have a weak trend developing. So again, potentially infant stages of a new bullish trend. And then you look at the Bollinger Band width and the Keltner channels. And for the good chunk of the day, we were above both. We finished below both, but we were above both for a good chunk of the day, and the momentum is still bullish. Hasn't really gotten to high levels yet, and then we don't have we'll have a green dot on Monday, but we don't quite have it yet today. So it looks like we're just getting started on a bullish run. So what I decided to do here is to sell the 35 delta, the 165, buy the 160 delta. So depending upon where we get filled in, do a few contracts. So I have a full $500 risk, so it ends up being about 3 contracts. About a 2-to-1 reward to risk ratio, which I like. So let's go ahead and confirm and send that through to our market outlook category. And there's our trade for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Friday weekend, everybody, and we'll see you all tomorrow.